Welcome to This Explainer. Today, we're unpacking the Nobel Prize-winning math that absolutely revolutionized modern finance. We're looking at a mathematical framework so profound, it literally transformed global markets from this wild landscape of intuition and, guesswork into a highly structured quantitative science. We're talking, of course, about the legendary Black-Scholes model. But before we get totally bogged down in complex academic equations and intricate market dynamics, we kind of have to start by asking ourselves this fundamental, really high-stakes question. How do you put a price tag on an unpredictable future? For decades, traders wrestled with this. If you're making a contract today that depends on where a stock's price is going to be, say, 3 months from now, how do you fairly price that contract right this second? It sounds impossible, right? The future is total chaos. But, as we'll see, some truly brilliant minds figured out how to mathematically map that exact chaos. Okay, let's build our understanding step by step. We're going to start with 1, demystifying financial derivatives, move into 2, the mechanics of options, uncover 3, drivers of option pricing, and finally arrive at 4, the Black-Scholes breakthrough. Section 1, demystifying financial derivatives. To understand our first building block here, we need to zoom out a bit and look at the broader category of financial instruments we're actually dealing with. Because you really can't understand the master equation without understanding the assets it was built to price, right? So, the absolutely crucial point is that these instruments, things like futures, forwards, swaps, and options, they don't have any intrinsic value on their own. Instead, their worth is entirely derived from the fluctuations of an underlying asset. It could be a stock, a bond, a commodity, even a benchmark index. When you buy a derivative, you aren't actually buying the asset itself. You're just buying a contract based on how that asset is going to behave. Section 2, the mechanics of options. Let's see how this builds into our primary focus for today, a very specific and massively popular type of derivative known as an option. To really grasp this, let's look at a practical, everyday example from our source material. Imagine a guy named Mr. X. He wants to buy this new car launching next month, but he hears a rumor that the GST tax rate might spike. So, Mr. X pays a small, totally non-refundable fee today, let's say 10,000 rupees, just to guarantee the current purchase price for next month. If the tax goes up, boom, he's protected and buys at the locked-in price. But if the tax actually drops, he's obligated to buy the car at that locked price. He can just walk away. He only loses his 10,000 rupee fee, which in finance we call the premium. Just like Mr. X's car booking, an options contract gives you a choice, not an obligation. A call option gives you the right to buy an underlying asset at a fixed price, which is known as the strike price. A put option, on the other hand, gives you the right to sell at a fixed strike price. The sheer beauty here is the limit on your downside risk. Neither contract forces you to make the trade if the market turns against you. Literally, the absolute most you can ever lose is the premium you paid to buy the option in the first place. Now, traders categorize these options based on how useful they are right in the current moment. If you hold a call option and their locked-in strike price is lower, meaning it's a better deal, than the current market price, you are in the money. You could theoretically exercise your right, buy the asset cheap, and immediately sell it at the higher market price for a quick profit. But if your strike price is worse than the current market price, your option is out the money, and it's essentially useless to exercise in that exact moment. Because of this dynamic, your option's total premium price is broken down into 2 main components, intrinsic value and extrinsic value. Intrinsic value is the immediate, tangible profit you'd make if you exercised an in-the-money option right this very second. Extrinsic value, on the other hand, well, that's the premium paid for the time remaining until expiration. Basically, it's the market pricing in the possibility that the stock might swing in your favor before time completely runs out. Section 3, drivers of option pricing. Now that we've got our core vocabulary down, let's look at the invisible market forces that are constantly pushing and pulling at an options premium price. What exactly changes that extrinsic value second by second? Well, think about time decay. It doesn't just trigger a steady, linear drop in value. When you're, say, 90 days out, the decay is pretty slow. But as that expiration deadline looms closer, the value actually plummets at an accelerating pace. As time evaporates, so does the probability of a profitable price swing, and the premium just drops aggressively towards zero. Another massive factor driving price is the economy's interest rates. Rising interest rates behave exactly like a seesaw in the derivatives market. As rates go up, the premium for call options goes up. Why? Well, because buying a call option is way cheaper than buying the actual stock, leaving you with all this extra capital. In a high-interest environment, you can put that saved capital straight into a bank, earn high interest, and that makes the call option more valuable. But simultaneously, on the other side of the seesaw, rising interest rates push the premium for put options down because the opportunity cost of holding the underlying asset to sell later becomes a whole lot higher. So combine the relentless decay of time and the seesaw of interest rates with the stock's current spot price, the contract's fixed strike price, and the overall market volatility, which is the expected variance or wild swings in the stock market. And what do you get? You get a chaotic soup of variables. A shift in just one of these completely changes the fair price of the option. Section 4. The Black-Scholes Breakthrough. For decades, pricing these options with all those constantly moving parts was essentially just educated guesswork. That is, until three incredibly brilliant minds decided to tame the chaos and bring some actual order to the market. Enter Fisher Black, Robert Merton, and Myron Scholes. Back in 1973, they published their groundbreaking mathematical model, originally detailed in the Journal of Political Economy, and it forever changed quantitative finance. The impact of their equation was so absolutely seismic that in 1997, Scholes and Merton were awarded the Nobel Memorial Prize in Economic Sciences for developing a new method to determine the value of derivatives. Sadly, Fisher Black had passed away 2 years prior, but his indispensable role was heavily recognized by the Nobel Committee. So, what did they actually achieve? Their elegant, hedging-based model managed to distill the absolute unpredictable chaos of the global markets down into just 5 exact variables to calculate the fair theoretical value of what's known as a European option. 5 variables. That's it. Let's look at those 5 variables. By simply plugging in the stock's expected volatility, its current underlying stock price, the agreed-upon strike price, the time left to expiration, and the risk-free interest rate, like, say, a government bond yield, traders suddenly had a mathematical map. They could calculate exactly what an option should cost. By continuously buying and selling the underlying asset in relation to this formula, traders could effectively hedge their positions and theoretically eliminate risk entirely. It was a total game changer. But, and this is a really massive but, to make this brilliant, Nobel-winning math work flawlessly, the creators had to make one fundamental assumption. The entire Black-Scholes equation relies on the assumption that percentage changes in the stock price over short periods are normally distributed. In plain English, it assumes the stock market generally behaves normally, smoothly, and somewhat predictably, following a standard bell curve of probability. Which brings us right back to reality, doesn't it? The market is definitely not always a smooth bell curve. So I'll leave you with this thought to ponder. If the entire foundation of the massive, multi-trillion-dollar global derivatives market relies on a formula that assumes standard, normal market behavior, what exactly happens to our financial system when a once-in-a-lifetime, totally unpredictable black swan crisis hits? When the math breaks down, how do we price the truly unpredictable? Thanks for joining me on this explainer, and keep questioning the numbers behind the chaos.